If you're still memorizing stupid candlestick patterns in 2026, you're cool. Because the market isn't moving because of engulfing or pin bar candlesticks. Those are just candlestick patterns. The real signal is what they are hiding. Who got trapped? Where liquidity just got taken? And whether price has real intent or is it just big? So in this video, I will show you the 5 things nobody understands about candles and how to use candlesticks the correct way as a confirmation, not prediction. Get into it. Yo, quick pause from the video. If you've been watching me for a while but you are still not consistently profitable or making the money that you want from trading, listen. Because here's the truth. You probably already have good enough strategies to be profitable. But the real reason that most traders still lose money is because they don't understand how the market works and they never fix the habits and psychology that's keeping them broke. And that's exactly what I'm solving with this 3-day bootcamp. Most traders are out here treating candlesticks like their magic signs. Green candle, buy. Red candle, sell. And that's why you keep buying right at the freaking thing right before it starts pumping. Now here's the truth about candlesticks. These candles on the screen, they don't create the move. Candles are essentially just the scoreboard after the move already happened. Which means a bullish candle doesn't mean price is going up. It only means that during that time window, right, when the candlestick is forming, buyers have managed to close higher. Buyer won the tug of war against the sellers. That's it. That's what a bullish candlestick actually means. It doesn't necessarily mean that price is going to go up right now. Similarly, once you see a red candlestick doesn't mean that price is going to go down right now. If it was this simple, every Tom, Dick and Harry would be freaking millionaires, innit? And this is exactly why the concept of buy when you see a green candle and sell when you see a red candle doesn't work. Because by the time the candlestick turns green, the move is often already done. And right now you're just simply like the last person chasing the move. Which means that if you're trading these candlestick patterns, you're not early. You're simply gonna be the exit liquidity. And I view trading as simply a game of liquidity awareness. The more consistently you can spot where liquidity is resting and when it's about to get taken, the higher your odds of winning. Which means higher chance of you making money, which means more profits to you. And the thing is, the traders who do not understand liquidity, they don't lose money to the market. They become the liquidity. So when you analyze a candlestick, instead of asking yourself, what pattern is this? Is this the engulfing candlestick or the morning evening star or whatever voodoo candlestick pattern? You should be asking yourself, where is this candle printing? And who is it trapping? Those are the essential questions for you to understand the context, for you to understand the objective of price. Now, unlike all of these trading gurus who like to use fancy words to explain shit that they don't really understand, I'm gonna make this stupid simple. So simple that even a 5-year-old can understand. Because I really believe that if you can't explain something simply, you don't understand it well enough. With that said, let's get into the 5 truths about candlesticks. You know what, let me take that back. I want to sound more cool and clickbaity while saying it. So I'm gonna expose the 5 dark truths about candlestick patterns that the banks are hiding for you. Let's go. The first truth is candlesticks are essentially an auction story. Right now, imagine a tug of war between your buyers and sellers. Each candle is simply the scoreboard for that time period. For example, right now I'm at the 1-minute time frame and this 1-minute candlestick is forming as we speak. And right now there's this tug of war going on right here between the buyers and sellers, right? So they are like trying to see who can take control of price. Because whoever end up taking control of price determines the direction in which price is potentially going to go. So when you look at the anatomy of a candlestick, you will know that there's your opening price, and then there's your closing price, and then there's the high, and then there's the low. The opening price is essentially where the game started, right? Where the tug of war began. The high is how far buyers managed to push price all the way up. And the low is how far sellers managed to push price all the way down. And the close is potentially who won at the end of that round. So when I look at a candlestick just like this, what this is telling me is that at some point of time, price opened right here, and then during this candlestick while it's forming, during this 60 seconds, during this 1 minute while it's forming, there was actually surprisingly a good amount of sellers who cause price to actually come all the way down here, right? Push price all the way down here. But then there's also a group of buyers who managed to push price all the way up here, right? But that was not sustainable, right? So as a result, sellers came into the market and caused price to collapse, right? Selling pressure, push price all the way down here, and the candlestick ended up closing right here. Basically, the top wick told us that the buyers tried to go up, but then they got slapped back down. And then the bottom wick told us that the sellers tried to go down, but then they got slapped back up. And when you see like a very long wick just like this, either upper or lower wick, it often means rejection. Okay, like this is something that we're going to talk about more in the next truth, right? But for now, just understand the anatomy of a candlestick and the tug of war to see like who's gonna get control of price, whether buyers or sellers, whether demand or supply. And the thing is, in trading, size does matter. Okay, size matters. And what I'm talking about is the size of the candlestick body. When you see like a big ass body just like this, what I call the BBC, the big bullish candle, this basically means that there's a lot of momentum, right? There's a real push in price and there's very less hesitation. There's a lot of buying pressure. But then when you see like a small candle body just like this tells us that more often than not, there's indecision in the market, right? There is, nobody knows whether price is going to go up or price is going to go down, right? So as a result, price just like consolidate around here. Okay, so this is a sign that there's indecision in the market is indecisive. We can't tell whether the bulls or the bears are winning because like they are still like just breaking even on this like tug of war. But then over here, it's clear as day that the bulls are winning because we got this big ass juicy bullish candlestick body. So just to sum it up, the candlestick that is forming right now, that's the fight. The close of the candlestick is who won the fight. And all of these wicks right here are failed attempts. So the next truth is candlesticks only matter at locations. What I basically mean by that is that you don't want to obsess over candlesticks when they're in the middle of nowhere, like freaking Wyoming, okay? Like you only want to care about candlesticks that is at a desired point of interest, at a location in which we want to be trading from. And I fundamentally view candlesticks as words. You know, in English, words mean nothing unless it's in a sentence. Let's say the word handsome, right? So handsome itself means nothing. But if you put it in a sentence like Brad is a handsome trader, then that means something. It means that I am indeed a handsome trader, right? So a word alone is meaningless unless it's in a sentence. And if you apply that to trading, location is the sentence. So the candlestick alone is the word. It means nothing. But if you put it in the location, at the right location, it forms a sentence and it means something. It allows you to have context over what price is doing. So you can develop your bias on whether price is reversing, price is blustering right to the point of interest, whether you should enter for a buy, whether you should enter for a sell. So to me, there are a few locations that make candles matter. Number one is previous swing low or swing highs, right? So basically, when price breaks structure, just like this is the swing low, this is the swing high, since this is the highest point before price starts pulling back. So this is where I'm going to be observing the candlesticks. Same as when price approached the swing low right here. And also, when you draw these swing highs and swing lows, you can also draw your supply and demand zone, which is another location that actually make candlesticks matter, right? So there's a supply zone right here, there's a demand zone right here. And then another place could be liquidity pools, right? So for example, there is available liquidity sitting below this swing low right here because the retail traders who entered for a long positions right here, they're going to be placing their stop loss below this swing low here. So as a result, there is going to be some form of liquidity sweep, like exactly what we have right here. And what happened was that price pretty much came crashing down, right? You can see there's a lot of selling momentum, a lot of selling pressure. But as it approached this demand zone, approached this swing low, approached this liquidity pool, it came down, swept the liquidity, and it started reversing very heavily right here. So if you didn't understand the context of price, you didn't understand the location, you couldn't spot where the candlesticks are, you're going to be thinking that this is price going down. So as a result, you're going to enter for a sell right here because you are convincing yourself that there's a lot of selling pressure, selling momentum in the market. But then what happens is that price just starts reversing against you. All because of liquidity, all because of the higher time frame objective. That's it. So basically, just to sum it up, the swing highs and the swing lows are essentially where price already proved that people care, right? That is why we got this bullish break of structure being formed. It does that the buyers are actually in control of price. And then the zones, right, the supply and demand zones, these are essentially the battleground where buyers and sellers are trying to take control of price to see who actually wins, because whoever wins dictate the direction of price. And then there's your liquidity, which is essentially where the market hunts stop losses, hunts stop orders. And then after the liquidity has been swept, we got this huge displacement right here as well, right? Like this huge displacement candlestick, which tell us that the market is essentially shifting bullish, right? So this is where the market shows its hand. So to me, I have like a very simple rule inside my mechanical trading system, which basically states that if the candlestick is in the middle of nowhere, that's just noise. I don't even bother analyzing it. I don't even bother looking at it. For example, if this is my swing low or my demand zone, whatever, and this is a swing high, I'm only going to be paying attention to the candlesticks that is formed when price reaches this location here, or this location here, which means if price is in the middle of like right here, right, I don't care. I genuinely can't be bothered to actually analyze the charts because that's just noise to me. So just to give you another analogy, a scary candlestick in the middle of the chart is like shouting in an empty room. Nobody cares. But the same candlestick at a major point of interest at a major level is like shouting in a courtroom. Everybody's going to be looking at you. So it's the exact same candlestick, but if you put it in different locations and you give it different context, it will give you different results, right? So for example, if you see this right here, it's at a perfect location. You know, you got like this reversal candlestick pattern, which tells that price is going to go up. This is where you can enter for longs, right? And it's most likely going to work out because it's at a perfect location. But then if you see the exact same pattern, like let's say somewhere around here, then what happens is that it's not going to work out as well because price is in the middle of nowhere, right? And it's really not at a desired point of interest. So that's how important it is to take into account the location and the context when you are using these candlestick patterns or candlesticks in general. The third truth is that candlesticks must be read in sequence, not snapshots. Now, once again, I'm just gonna explain it in like a 5th grader level. Basically, one candlestick is one word. A few candlesticks in a row is a story. One word alone means nothing without context, right? Which means that you need to rely on the subsequent candles or the candles that came before that one candle to understand the context of the market, to understand the story of the market itself. So basically, you want to look at the 3 to 5 candlesticks at any given time, rather than just relying on one candle alone. So for example, look at this blank chart. I'm going to take this 5 candlestick right here. And when I do that, I'm going to be asking myself the following questions. Are the closes getting higher or lower, right? Is the candlestick closing higher or is the candlestick closing lower? And over here, I can see that the candlestick was closing lower, right? It closed here and it closed here and it closed here, here. So this means that there was bearish momentum in the market, but the next candlestick started closing higher. And the next thing is, are the wicks getting rejected repeatedly at the same price? What I basically mean by that is that if you look at a wick, right, and observe where the price is wicking towards to and where price is like, you know, getting rejected from. Okay, so for over here, right, price actually came down. When this candlestick was forming, got rejected, hit back up. Same thing right here, came down again, got rejected and hit back up. And then later on, price came down, got rejected and hit back up as well, right? So this means that there is quite a good amount of like buy order sitting in this point of interest itself, which means that the next time price actually come down here, there's gonna be buying pressure, right? Which explains why when price came down to this area here, price pretty much retested it with this super duper long low wick, but then it ended up closing right here because there's a lot of buying pressure. And then eventually the buyers overwhelm the demands and then it starts causing price to reverse. And are bodies getting bigger, which signal momentum, or are they getting smaller, which means that the price is just stalling? So look at this, clear as day, you can see the candlestick body of the bearish candlestick start getting smaller and smaller, which means that the selling momentum is like fading away. And then boom, you got a huge big bullish candlestick right here coming into the chat and just like engulfing all of these like previous small candlestick right here, which means that there's a lot of bullish momentum in the market. And I can see at this point of time, there is like barely any selling pressure whatsoever, right? Like there is really barely any sellers in the market. The demand just came in here and just kicked the stupid sellers out of the market. And this is a clear sign that the market has actually changed behavior.